I just want to start off by talking about America, which has gone through quite a difficult time in the last week or so. A week ago, the markets were discounting a rapid recovery in the American economy, and that was being discounted directly into the S&P 500, which was rising quickly. And then suddenly, the number of cases in the United States, the COVID cases, spiked up. On the 20th, there were 31,000. On the 23rd, 39,000. On the 25th, 44,700 cases. And suddenly the perceptions that the pandemic was under control evaporated. The S&P 500 over 3 days, from Wednesday to Friday last week, fell by 3.5%. Now it is 6.9% below its cycle high at 32332, which was made on the 8th of June, and 11% below the all-time high of 3386 made on the 19th of February this year. Technicians had to keep adjusting the recovery trend line. If you look at the chart on your screen, you'll see how we started off with a recovery trend line there, and it's been gradually getting wider and wider and wider and wider. And then the movement on Wednesday and Friday last week brought us down to this point here. When we started talking about COVID-19, and that was in March this year, we said that the market will almost certainly follow the perceptions of the virus's progress. And that is exactly what has happened. Investors now fear that major parts of the US economy will have to go back into lockdown. And that is being discounted into the S&P 500. What is interesting, though, is that over this period from about the middle of March until now, there's been a big gap between what investors have been doing and what the media, the journalists and the economists have been saying. On the one hand, the journalists and the economists have been talking about panic and how things are very bad and how it's going to take a long time for everyone to recover, and all their media was generally very negative. But at the same time that they were saying all those things, the stock market was going up very steadily until the last week or so. The doom and gloom scenarios obviously do sell newspapers, and the market was rising despite that. Because investors don't believe that. They believed that there was a recovery and there would be a quick and strong recovery until a week ago, and then their perceptions changed very quickly. The reason they thought there would be a good recovery is because of surplus capacity. The lockdown created enormous surplus capacity in the economy. That means that there were plant and machinery ready to go. There were employees who were already trained, so they could easily be brought back into production very quickly. And on top of that, there was this massive government stimulation in America. And it's important to understand that journalists and economists lose nothing if they are wrong. But investors can lose millions or even billions of dollars. They have to be right, so they make it their business to do their homework as carefully as possible. And they also look ahead. They make decisions based on where the economy will be in about a year's time, not on where it is now. So you need to think about that. They are thinking about where is the economy going to be in June, July of 2021. And by then, it seems probable that there will be some kind of vaccine. However, in the short term, there may be a certain amount of lockdowns taking place in America, perhaps in specific cities where there are hotspots, or even specific states. But we think that that will be patchy, and it will be much less impactful than what happened when the virus first came on the scene. And we believe that by the middle of 2021, America should be vaccinating everyone, and this problem should be disappearing. As a private investor, though, you need to decide on your own view. What do you think is going to happen? In the short term, it looks like the number of cases in America will get worse. But it will not be anywhere near as bad as the initial spread of the virus. The impact of it, that's what I'm talking about. because we know far more now about how to control it. Masks, social distancing, sanitizing and washing of hands, etc. These things can reduce the rate of infection by 50% or more. We now know that. The bottom line is that the resurgence will probably be less impactful on the stock market than the original bear trend. So what we're looking at now is more of a correction, which you can see on the chart here. I've plotted it in. From that cycle high there at 3232, you've got a bit of a correction going on. We do not think that this correction will be sustained, and indeed last night's 1.5% move up on Wall Street shows that we are probably right. But you must decide for yourself. We think that by the middle of next year, the COVID-19 pandemic will not be a major factor in markets as it is now. All right, let's look at our economy here in South Africa. In previous confidential reports, we have spoken of 3 areas of reform which the ANC needed to undertake in order to get the economy moving properly. The first was that they needed to sell off some of these state-owned enterprises. We have over 600 state-owned enterprises. Some of them are profitable, but many of them are not, and require constant bailouts from the government. So that was the first area. If they sold those state-owned enterprises off, they could quite conceivably generate a good chunk of capital which could help us with our debt problem. The second thing that we thought they should do is to reduce the size of the civil service. And obviously this is what is going on. Tito Mboweni has spoken about this, and he's already got a plan to reduce the civil service wage bill, and we'll see how that goes. And the third area was labor legislation, which at the moment is very heavily skewed in favor of the employee, and it needs to be moved so that it's more employer-friendly. That will ensure that employers employ more people because it will be easier for them to get rid of them if they need to. It's the American idea of the more you are able to fire, the more you will hire. All 3 of these things mean a conflict with the unions, though, and they are politically difficult. But of course, COVID-19 has brought these into sharp focus, and we need to do some reforms, and we need to do them quickly. The government is desperately trying to balance the budget without quantitative easing, and the easiest way would be to sell off some of those state-owned enterprises and generate some cash. The new budget, which Tito Mboweni produced on the 24th of this month, was an almost impossible task. The cost of COVID-19 and the 304 billion rand shortfall in tax collections, and then 230 billion has to be saved out of government expenditure over the next 4 years, and that comes on top of the 160 billion that he promised to shave off the civil service wage bill. And then, of course, in addition to that, to help finance that, 40 billion rand of unspecified tax increases have been put or are going to be put through. And he is proposing to raise $7 billion from the IMF, the World Bank, and so forth. That still leaves a massive budget deficit of 15.7%, more than double the budget deficit proposed in his February budget. And we have to live with that, and we'll have to pay that off over a period of time. Most economists are talking about the economy shrinking at the rate of 10% this year, but the Treasury is talking about 7.2%. Of course, the advantage is that only about 10% of our debt, the government's debt, is dollar denominated. Most of their debt is in rands. So fluctuations in the currency do not impact on our national debt. Otherwise, we might be in the same position that Argentina is, where they have had to default on $65 billion worth of debt. Both Tito Mboweni and Kganyago, the governor of the Reserve Bank, warn that it will be a long, hard struggle to repay, and everyone will earn less and have to work harder. Kganyago remains resolutely opposed to quantitative easing, but he might change his stance if things get bad. Mboweni says that the ANC must do zero-based budgeting. In other words, they must start from the ground up. They must re-examine each cost in the budget to see if it is really justified in view of the new situation in the post-COVID period. And of course, that means the ANC will have to rethink quite a lot of its holy cows. hundreds of SOEs which are unprofitable. They need to be rethought. We have to accept that the government cannot be the only organization that creates employment. In fact, that the only way to overcome our unemployment problem is to stimulate private enterprise. That needs to involve a lot of changes for the ANC government. They must become more business friendly. The civil service unions are already fighting with Tito Mboweni in court. Cutting the civil service wage bill was the only way to balance without quantitative easing. And Kanyago says that quantitative easing is not an option at this stage. We don't need it, he says, not yet. But he may eventually do it. It's notable that after the 2008 subprime crisis, the government injected 800 billion rand to re-stimulate the economy. In this crisis, COVID-19 crisis this year, they could only rustle up 500 billion. And obviously, if you take into account inflation, that means that their stimulatory package this time was less than half of the 2008 stimulus package. Unemployment in the first quarter of this year rose to 30.1%, and that is before the lockdown, so that's the March quarter. The second quarter will undoubtedly be far worse, but the third and fourth quarters should be better. The leading indicator fell by 5% in April. That's the worst single month on record, but I guess it would be expected to do that. The impact of COVID-19 can be seen on the JSE in the FIN30 chart. So let's just have a look at that. This is the financial and industrial 30 chart, which is the 30 largest financial and industrial companies trading on the JSE. And as you can see here, it made this very nice V bottom, which bottomed out in March. And since then, it's been trending up quite nicely, following Wall Street, of course. And you can see the progress there. The government's post-COVID revival depends on 55 infrastructure projects which they have put out. These will be done with private-public partnerships and involve roads, housing, ports, energy, a whole range of different things. But we must not forget that Ibrahim Patel, who was a minister in the government, in 2014 proposed 640 infrastructure projects, and nothing really happened. So we have to see whether these 55 projects are actually put in place. The construction industry, of course, has been decimated, and there's a definite shortage of high-quality skills, civil engineers and people like that. In the ANC's discussion document, they talk of bringing back prescribed assets once again. Obviously, this is not a mechanism which is really something that's encouraged by investors. It's frowned upon, in fact, and in time it may result in us getting even lower ratings agency gradings than we're getting now. The 26 billion to refinance SAA was notably not in the adjusted budget. Hopefully this ego fantasy will now die a natural death. Looking at the economy itself, vehicle sales, there were none in April, of course, virtually none. But May month, by the end of May, we were down 41% in vehicle sales on last year, and we should be down about 25% for the year as a whole. The national payment system in May showed that 13% less was paid in salaries and wages to people in South Africa, 13% less. And that gives you a good idea of the extent to which people have had to take salary cuts, and also the extent to which people have lost their jobs. Now, of course, if you want to know what's happening in South Africa, and particularly what overseas perceptions are of this country, the best place to look is at either at the long bond, the yield on the long bond, or at the rand. So let's start with the yield on the long bond. I'm going to look at the R186. I'll put that chart up on the screen now for you. Let's just put a bit more data on. Here you can see how the yield on the long bond spiked up when COVID became a major issue, and then has trended down over that period of the last month or two. And we have now back below the levels that we were at before the COVID crisis began. Part of that is due to the Reserve Bank entering the market as a buyer of our long bonds, and part of it is also due to a return of foreign investors to an extent. Those figures are backed up by the rand. So let's just take a quick look at the rand here. Obviously, if people are bringing money into the country, it's good for the rand. It strengthens the rand. So if you look here, you can see that there was a support level at 15.50 Rand to the US dollar. And we had this breakout here. And then that was followed by a double top in March and April, which signaled a sort of top of the COVID-19 bear trend. And since then, the rand has been strengthening until recently, the last week or so, where this resurgence of cases in America has tended to put sentiment back onto a risk-off basis. So the international community has moved back towards risk-off, temporarily, we believe, as a result of fears around a second wave of COVID-19. Obviously, the Reserve Bank intervention has helped, and the return of overseas investors can be seen here. We believe that the underlying sentiment, though, is towards risk on, and therefore we can expect the rand to strengthen in the medium term. Now let us look at some general factors which have impacted on our economy. The first one is, of course, the agricultural season. We're having a very good agricultural season. The maize crop is expected to be about 15.5 million tons. And remember that this usage in South Africa, the normal average usage is about 11 million tons, which means that we'll have about 3 million tons of maize to export. Some of that will go to Zimbabwe, which is in a terrible state, but a lot of it will go to create forex, will generate foreign exchange for this country. In 2019, agricultural exports generated 10 billion rand in foreign exchange, and they accounted for 3% of our GDP and employed about 1 million people. This is very important, this agricultural season, because a lot of people in South Africa are subsistence farmers. There are literally thousands and thousands of subsistence farmers who rely on growing a little patch of maize behind their kraal to feed themselves. And in a good season, they don't have to rely on government subsidies and charity and so on. In a bad season, they can cause a drain on the economy. Then let's look at some other things that impacted on the economy. African Bank came out with its results. African Bank, of course, is what's left of African Bank Investments Limited, or ABLE as it used to be known, which was taken under administration by the Reserve Bank and then finally reconstituted. They're not listed yet, but they report a surge in bad debts. And obviously you must remember that African Bank still has a lot of micro-lending clients. So this surge of bad debts is indicative of the strain which people are taking in the communities. And they reported an after-tax loss of 311 million as a result. On the positive side, Eskom is looking quite good. The new CEO, Andre de Ruyter, says that he will have no need of government support, financial support for the rest of this year. He's been cutting all unnecessary expenses. He predicts that there will only be about 3 days of load shedding this winter because they're operating at about 70% of their capacity. So that's all good news. They took the opportunity of load shedding to improve and upgrade some of their plants and their generators. So I think that will help us through this winter. But we still expect about 30% of businesses to fail due to COVID-19. The shutting down of the economy for 6 weeks and the partial shutdown that we're still involved in is going to damage small business. We don't think it'll be quite as bad as 30% of small businesses. We think it will be less, but some industries will clearly suffer very badly, most notably tourism. The tourism industry is in a parlous state and is unlikely to recover very well. Another sector that's quite surprising is the medical profession. A lot of doctors have seen a drop-off in the number of patients coming to see them. Patients have also not been going to hospitals for fear of contracting COVID. And the result of that has been a very sharp drop-off in medical practice revenue. And a lot of doctors are in difficult situations. So that is another industry which is not doing very well. If we look at the commodities industry, though, the mining area is doing quite well. Production did fall in March. It was down 18% in March and then 47.3% in April. But April was the month where we had a very strong lockdown. Gold, platinum, iron and manganese were all down 50% in April, and coal, which was an essential service, was down only 9%. May and June should be much better. About 450,000 mining employees are returning to work. So far, as they've been tested, returning to work, 525 have been found to be positive, having COVID, and the rest of them are okay. The total cost of the lockdown in the mining industry is probably around 100 billion rand. The deepest mine in the world, which is Mponeng, has found that 1/3 of its employees tested positive for COVID-19, but they were all asymptomatic, which means that they had no symptoms at all. But they were positive, which means that they've been spreading this disease in the tribal areas and in the squatter camps without even being aware of it. So that is obviously a consideration. Okay, let's look at some companies now. First of all, I just want to say that just look at the JSE Overall Index. And you'll see here from this chart that the JSE Overall Index has recovered very sharply. In fact, it's up 43% from its March low, 19th of March 2020. It's obviously following Wall Street up, and the buying opportunity that existed in March and around April is dissipating quickly. One sector that remains in difficult condition is the banking sector. So that is a sector you could still look at. It still remains, in our opinion, very cheap. As you can see here, there's a base formation here, but it hasn't really recovered. It's been drifting sideways and downwards, and we're sitting now on a price-earnings ratio of 6.3 with a dividend yield of 9.37. You've got to remember that this banking index represents some of the biggest service industry companies in South Africa. Of course, the fear is that there's going to be a huge rash of bad debts, that people are going to default on their loans and their overdrafts and their bonds, and that will impact on bank profits, and that's why the banking index is this low. But I, in my experience, have not seen it as on this type of price-earnings ratio or this type of dividend yield for a long time, probably not since the 1987 crash. So I believe it's cheap at these levels, and if you want a really good quality blue chip share, you could do worse than buy, for example, some FNB or some Standard Bank or even ABSA or Nedbank. They were all looking good, even Capitec's looking relatively cheap. All right, there's a new listing coming onto the JSE, unbelievable. It's a company called Bushveld, which mines vanadium. They are looking at having a listing on the JSE sometime later this year. It will be a secondary listing. They're already listed on the London Stock Exchange in the alternative investment market there, the AIM. We believe it should be a good share because vanadium is used widely in the manufacture of steel. But of course, you must remember it is a commodity and therefore risky. So we should see that later on this year. Just keep an eye out for it because I think it will be a good investment. All right, let's look at Capric. Capric is a financial technology company or a fintech company which seems to be bucking the trend on the JSE. It's going up when all the other shares are going down. It is owned by Patrice Motsepe's African Rainbow Minerals, ARM. And what's good about it, this company provides software solutions to the banks. So it has all the major banks as its customers. And it looks like it's trading at a very good price-earnings ratio. There you can see it 8.43 and on a dividend yield of 4.44%. We think it's good value. There's 560,000 rands worth of shares changing hands daily, so there's plenty of volume for private investors. Okay, let's look at Hyprop. This is obviously a very well-known real estate investment trust or REIT. It owns the Rosebank Shopping Mall, Canal Walk, Hyde Park Corner, and Clearwater Mall. So it's got some excellent assets. and of course it came down with COVID very sharply, and we recommended at that time that you should put on a 200-day moving average and wait for a clear breakup. But as you can see, there's a big island formation here, and the share seems to be moving up off that island formation. We think it looks relatively cheap, and you must bear in mind it's trading in the market right now for less than a quarter of its net asset value. So that has to be a consideration. The next share I want to look at is Labat. I've done some analysis on this, but I think it's quite instructive for you to have a look at it and consider what I'm trying to show you here. And this is about insider trading and the volume that it creates. Every company listed on the JSE has got a small group of people, probably 6 or 7 people, who have inside information. They know when there's a takeover going to come about. They know when something's going to happen that's going to be very good for the company or very bad for the company. And inevitably, some of them will trade, probably not directly themselves, but through their relatives or friends. They'll tell people, look, you must buy this share or you must sell that share. And that is insider trading. It's illegal, but it goes on all the time. However, they cannot hide it from you because it's visible in the volumes traded. So if you look at Labat, this company is interesting, and it's become very interesting because it's the only listed company on the JSE that is investing in the exploitation of cannabinoids, in other words, marijuana. And as you can see here, if you look at the price pattern, this share was trading over here in around the 10th of June for about 29.30 cents. And the volumes were starting to pick up, but hadn't really started. You can see at the bottom here, I've got a volume histogram. And what I show in the middle here, in the middle chart, is an on-balance volume chart. And that shows a sharp rise from about this day here. We wrote an article about it. We were a bit slow off the mark here, but we got an article out to you on the 22nd when the share was 49 cents. Since then, the share has gone up 38% in the last 5 or 6 trading days. And that shows you why it's so important to follow the volume traded on a share. And the best way to do that probably is with the on-balance volume chart. But you can see if you look back over the history of Labat, in this volume histogram, it had very thin volumes. And then suddenly over here, the volume started to pick up very dramatically. And that is a definite sign that the insiders are buying up shares. So they go into the market big time and they pick up shares from people who don't hold the share strongly. We call them the weak hands. So the strong hands take the shares away from the weak hands. And you'll see that with massive increases in volume and small incremental increases in price. That is the signal. If you get that combination, you can be just about certain that there's insider trading going on, and you can jump on the bandwagon. You may not be able to find out what is going on, but inevitably, if you see this kind of signal, you will make some money out of it. So now you can see the share's gone up. It's trading now at about 74 cents. There's probably a bit of profit taking going on, but we think maybe the share will go a little higher. But now you're in dangerous territory. If you'd acted when we sent out that article on the 22nd, you would be up 38% in about a week, which is a pretty good return. Okay, now I want to talk about MultiChoice. You remember when MultiChoice, it's called the MC Group, by the way, in your share software, MC Group. And here you can see it on the screen. You can see the impact of the COVID-19 effect, the bear trend there. And then it's been stabilized, and now it's moving up quite strongly. This is a very good share. It was spun out of Naspers a little while ago, so it was a Naspers subsidiary. They spun it out and listed it separately. It is Africa's largest pay TV company with 20 million clients in Africa. It's now adding content from Netflix and Amazon, and it's moving also onto the internet in offering a broadband opportunity. The share price has been rising strongly, and that is partly because during the lockdowns and during COVID, a lot of people have been looking for entertainment, home entertainment on the internet or from their pay TV service. Right, let's look at Telkom. Telkom, as you know, was a government-owned telephone company, mostly in the fixed line area. A little while ago, in fact, in the last confidential report, we suggested that you should apply a 65-day simple moving average to it. And as you can see on the screen here, there's a very clear buy signal given there on the 2nd of June, where it breaks up through that 65-day moving average at 2178, 21 Rand 78 cents. It has subsequently moved up. It's now trading for 29.45, which means it's risen 35% since it gave that buy signal. You could have made yourself a nice piece of change if you'd bought in at that point. Then I just want to talk about Prosus briefly. Prosus produced its financial statements yesterday for the year to 31st of March. We did advise you to buy this share quite a while back, actually in March. It was about over here on the 24th of March. The share was then trading for 1,138 Rand. Today, it's trading for 1,561 Rand. It's gone up very, very strongly over that period of time. In their results, they show that their turnover is up 17%. And as you may know, Prosus owns 31.2% of Tencent, which is a Chinese gaming and media, social media company. Tencent's turnover itself was up 16%. Also, their e-commerce division went up 33% in turnover terms, and their food delivery business doubled in size. Headline earnings for the period were up 13%, which is fantastic. The company is sitting on a cash pile of $4.5 billion US dollars, not rands, US dollars. And it's got facilities, dollar facilities of $2.5 billion. So it's got about $7 billion at its disposal for acquisitions in this time, which is roughly 121 billion Rand. So they will undoubtedly be taking up some good acquisitions. They will take advantage of the fact that there are many distressed companies out there. Some of them are very good, but they need capital. And it's an opportunity for Prosus to strengthen its position in various areas, particularly things like e-commerce and food delivery, fintech, those kind of things. Anyway, we did alert you to the share right at the beginning of the COVID pandemic and the bear trend back in March, and we believe the share will continue to perform exceptionally well. Ladies and gentlemen, that's what I have for you today. I hope you enjoyed it and learned something from it, and I look forward to talking to you again at the beginning of next month.